This is the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Any postings and or social media content are the views of the advisor and do not necessarily reflect BMO's position or viewpoint. The information herein is for Canadian residents only and does not constitute any financial, legal, tax, investment, or other advice. Thank you for joining us for the Wealth Roundup for the week of June 26th, 2026. I'm Terry Evans with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. If you're watching this or listening to it, we do hope you'll share and subscribe to the YouTube channel so that we can get a few more people that are in the know when it comes to wealth management. And of course, we resort to Patrick now to tell us the latest on the markets over the past week since our last episode. Patrick.
So where do we start? So markets, U.S. market is slightly down today. Kind of a broad sell-off, both in technology and commodities. At this stage, it's still relatively modest. We're still very close to our one-year target, but since the taping of our last podcast, the U.S. market is down about 2%. TSX is actually slightly up to date, but it too is also down about 1% over the past week. We were actually expecting the end of last week to be an exceptionally volatile market, but both the Canadian market and the U.S. market went on to set new all-time highs. And, we had kind of one of these triple witching events again with options expiry dates, which we've kind of seen before, led to volatility. Didn't happen, but it looks like perhaps it just got kind of delayed into this week. I think the other thing that there should be no surprise is that we got introduced to the new Fed chairman last week, Kevin Warsh, and perhaps surprising to some is he came out a little bit more hawkish with regards to rates, and so following last week's announcement that the U.S. Fed wouldn't be doing anything with regards to rates, is that the expectations actually came out that perhaps there would be higher rates in the U.S. by the end of the year. Now, I don't suspect that. I think that probably the U.S. will continue to hold rates, that inflation, which has become more problematic in the U.S., will probably settle down or show signs of settling down by the end of the year, assuming that, through the course of the next 60 days, that we start seeing oil flowing out of Strait of Hormuz. I think these pullbacks in the market, they're healthy, they're normal. We're still expecting the second quarter results for this year, which will come out in July, to be very good with regards to earnings. So that'll be something that will perhaps kind of be a tailwind once we get past this week. So on the oil front, so WTI is at $73 a barrel today. So still kind of holding in at that lower price. I think what's interesting for Western Canada, Western Canadian Select is trading at 61.51. So that differential is the most narrow differential that we have seen in the past 2 months. So sitting at around $12. So recall we saw it at around 16 about 6 weeks ago. It narrowed last week, kind of continues to narrow. So that's good for Western Canadian producers. Gold continues to be weak. So now gold is now in negative territory on a year-to-date basis. So it'll be interesting to see how that story evolves throughout the year. I'm expecting the U.S. dollar to remain relatively strong if they're not cutting interest rates. There has been this inverse relationship with gold and the U.S. dollar. If the U.S. does stay on the sidelines, doesn't cut rates this year, is expect gold to perhaps weaken even further. And that kind of gold carries down kind of all precious metals. And then lastly, Bitcoin, which we kind of take a look at. It's been a little bit more stable after getting taken out to the woodshed. It's still down a little bit over the past week.
Yeah, you've touched on pretty much everything, from oil to gold to Bitcoin to the Fed. There's no technology bubbles or IPOs that are going to be affecting the markets in the near future.
Actually, so a couple points on with what you brought up, Terry, is I think it's interesting that you highlighted that I think we are going to see some rotation. So the markets themselves, if we just look at the broad indices, is that we would expect them to continue to fare well through this year. Whether or not the next 6 months kind of looks like the last 6 months, I don't suspect that, because we're already at our full year target based on us looking at the indices. But I think there are some sectors that are going to find themselves under pressure. So the chip makers, which have had a really good run over the last 12 months, and always seem to be coming out with another very positive announcement of either a new innovative chip that's better than the last one, and then new orders. Their order books being full for the next 3 or 5 years. Is that really looks like the chip makers are kind of running out of runway for more and more good news to drive up their stock price. With oil prices coming down, is that we shouldn't be surprised that some money is coming out of that sector. So oil stocks kind of coming off that high. So just like I think when SpaceX IPO'd, there was likely some investors that were selling some of their other winners in their portfolio so they could participate, maybe buy some SpaceX shares. Is that, as we talked about in the last podcast, there's only so much money out there to invest in these ideas. And so, there's no such thing as the money tree, which you can continue just to kind of pull down to add to a new idea. Is that you usually have to take money from Peter to pay Paul. And so as we kind of see this rotation, is you're just naturally going to see some winners and losers. That doesn't necessarily mean bad for the markets. It can just mean that if you're over concentrated in one particular sector, and technology as a sector has a number of different components to it. Even within the Mag 7, you have a number of different components to it. So you could have Google and Amazon winning, but you could have Microsoft flailing because software is finding itself in the eye of the storm. There's also 2 more big IPOs coming out this year, Anthropic and OpenAI, which we'd also expect that they're going to grab some headlines, and that again, some investors are going to want to maybe take a look at their winners, maybe look at where they're overexposed, and draw from that. If you're running a diversified portfolio, even if you're equal weight on some of the big key benchmarks, is that I don't think it's as important to necessarily be redeeming, because you'd be redeeming and basically buying back the same things that you want in your portfolio anyway. So yes. So I think we are going to continue to see this sector rotation. I feel it's still healthy. I do think that the outlook for interest rates in the United States probably takes away some of the tailwinds that we were maybe expecting in the last couple of years. If U.S. interest rates were to go down, that would be very good for the markets. Now it's looking like the U.S. interest rates may not be going down very much. And in fact, in Canada, we may see an interest rate increase sometime in the next 12 months.
You talk about a lot of the things that you could have in your portfolio, some specific things there, right, when it comes to the markets. When it comes to a portfolio, when it comes to savings, what's best? RRSP, RSP, or TFSA? Which direction should people be going, and is it different for everyone?
So this is a great question, Terry. We get this question all the time. The various options for where you can save your money can be confusing to investors. So, we've got these 2 great options, similar in some ways, in that while your money is inside of these accounts, you're not paying any taxes on your growth within those accounts. Certainly taxed differently when the money comes out. The RRSP, everything's getting taxed when it comes out because you were largely deferring the tax on those investments. So I go back to what we often talk about is, before we make that decision, TFSA or RRSP, do we have that financial plan? Do we have a good idea on how we're going to utilize our assets over our lifetime? It's really like looking into a crystal ball in terms of when we're going to tap into those various sources of wealth. And so I find that the TFSA probably gives the most flexibility with regards to savings. So if you're not as certain about your time frame in terms of when you're going to use those assets, is that the penalties for perhaps getting your timeline wrong are less so with the TFSA. So I find that the TFSA works probably best when the time frame for needing that money is either shorter than an RRSP or very, very long, perhaps money going into your estate. Whereas with an RRSP is that really the big win for an RRSP is you're able to defer income or defer when you're going to need that money from a period of time where you're in a high marginal tax bracket into a period of time where you're even in a slightly lower marginal tax bracket. That sounds like winning to me if you're able to achieve that outcome. And again, that's hard to do unless you can somewhat, hop in the DeLorean and look into the future a little bit. And so, I like the RSP for that reason. And the RSP generally offers more contribution room than the TFSA does. So I would say, not sure, TFSA. More confident, clearly being able to defer to a lower marginal tax bracket than the RSP, to me, is a big winner in that case.
And that's, of course, you have to reach the 1.21 gigawatts in order to get up to 88 miles per hour. And then down the road, you can upgrade to the Mr. Fusion to power your DeLorean. So,
where's Doc when you need him, right?
what about, we often reference the Fed and the Bank of Canada with interest rates. When it comes to interest rates for people who are still affected by those, what's best, a fixed or a variable?
So, Terry, this is a real timely question because we often think of the spring as real estate season. The kiddies are getting out of school. If it's time to move the family, you tend to kind of want to do it during the summer. If you're going to do some kind of spring cleaning, or if you realize that maybe your house doesn't suit your needs anymore, is that, hopefully you've got just more buyers and sellers in the market in the spring. So going and talking about mortgage options, I think is very timely right now. Compound that with lots of, discussions about inflation. And then there's this really strong connection between inflation and the direction of interest rates. So, the two, Canadians love mortgages, so like and compared to the Americans that, you can go get a mortgage in the United States and you might have that same mortgage for 20 years. Whereas here, the most common mortgage term is, either a 5-year fixed or a 5-year variable. But, we see lots of people, kind of game that strategy by looking at maybe a shorter term. Is that Canadians just do a lot more mortgages. And probably if we looked at the stats, we could probably even say, that Canadians are pretty comfortable with mortgages. They're pretty comfortable with that type of debt. But the decision making to know what type of mortgage makes sense in that specific application. So this mortgage, this house, is that this is, I think, where you really kind of want to lean, on a mortgage expert. And so I reached out to Leslie Pappas, who's a BMO mortgage specialist. Leslie, actually, we used to work together at BMO West Point. She worked with me at BMO Nesbitt Burns for a number of years. She's now a very successful, knowledgeable mortgage expert. So kind of had her run through today where mortgage rates are at. So just to kind of a little bit of perspective, a 5-year fixed rate mortgage, at least from a posted rate perspective, is a little over 6%. And then you have a variable rate mortgage, which is at 4.45%. So you take a look at that, and some people will say, well, that's a no-brainer. Wouldn't I always just go with a variable? Don't you just always go with the lower rate? And I think Leslie pointed out that it really depends on a number of different things. And this is where the advice becomes, important, is that sometimes the posted rate on the fixed rate isn't the actual rate. So you really want to go and look and say, are there some other features to this, or would I qualify for, a rate other than the posted rate on that fixed term? And I think this is where we have to be really kind of careful as you kind of dig into all the terms and conditions, and maybe even some of the other things that the banks throw in. So, I was watching World Cup soccer last night, and one of our competing banks, must be a sponsor of the World Cup. And, and they were talking about some of the bonuses that come with a mortgage. So maybe they're going to give you a free barbecue, or they're going to give you some air miles, or they're going to give you some kind of cash back. And, maybe some of those things will kind of draw you into, one one mortgage at one bank or one type of mortgage over another mortgage. So again, really careful to go and say, which makes the most sense for me? So in general, if you think that there's a chance that you might be selling your house within that 5-year term or having to break that term for some reason, is that you really want to know what the penalties are. So if you think that there might be an upcoming wedding or maybe a move due to work, is that you really want to go and look to see which of those mortgage types has the bigger penalties. In general, a fixed term mortgage is going to have more penalties for breaking that mortgage along the way. So that would be a key part of the decision. With a variable rate mortgage, where some of the risks there come from is rising rates. Rates going lower, that's what we'd all hope for if you're in a variable rate mortgage. But rates going higher, that's where the risk is. And I would say that probably if we look at the last 30 years, is that interest rates have likely been in a lower trend than say perhaps they were in the 60s, 70s, or 80s. So a variable rate mortgage has probably given you the better outcome. But if you're in a household and things are tight, and all of a sudden interest rates start moving up on you, and you've got a variable rate mortgage, that may bring some stress to your household that you just don't want. And so I think if you're going to employ a variable rate mortgage, you want to certainly look at the direction of interest rates. And so you might look at, say, the 10-year bond rate, which might give us a little bit of an outlook in terms of where rates are going, or maybe a 5-year or 2-year to get an idea where maybe shorter term rates are. And then have a strategy and saying, well, if rates move up on me, what am I going to do? I think in both cases, I'm always a big advocate of going to my clients and saying, yeah, you may go and get a 25-year mortgage or a 35-year mortgage, but I'd really like to see you put in a plan that this is only going to be a 10 or a 15-year mortgage.
Right.
Come up with a plan that you're increasing your mortgage payments, that you're putting down lump sums. And I think in a scenario where you've got a variable rate mortgage and rates start to move up on you, you want to have already been doing that. Is you want to be applying additional payments, paying down the capital, so that if that interest rate ends up being higher, is that you can still stay on track for when you want to have that mortgage paid off. So I think when it comes to selecting that mortgage type, as I think it has a lot to do with your risk tolerance, and just maybe having some certainty about where you're going to be in your plan. I think going and looking at maybe some of those unexpected life events that could occur, I think you want to definitely be able to factor that in. Certainly going and looking at all the terms and conditions, and maybe looking past the bonus above ground swimming pool that you might get with your mortgage. Yeah. And then really making sure that you've got a mortgage that is tailor-made to your financial needs.
Very good. If you want to reach out to Patrick, you can find all of his contact information at www.patrickmleonard.com. You could also reach out to Patrick if you want to talk to Leslie about mortgages. For wealth management or to start your investment journey, same web address, www.patrickmleonard.com. And there you go. That wraps up the Wealth Roundup for the week of June 26th, 2026. Thanks very much, Patrick.
Thanks, Terry. Have a great week.
This has been the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. I'm Terry Evans. The Wealth Roundup is part of the Reluctantly Podcast Network.